This video I will explain how mutual fund returns are calculated. When you invest money in a mutual fund, one common question is, how much profit did I earn? The answer depends on mutual fund returns. What are mutual fund returns? Mutual fund returns show how much your investment has grown or decreased over a period of time. If your investment value increases, you earn a profit. If your investment value decreases, you have a loss. Now we will see real life example. Imagine you buy a small mango tree for 1000 rupees. After 1 year, someone offers 1200 rupees for the same tree. Your investment has increased by 200 rupees. That increase is similar to a return on your investment. What is NAV? To understand mutual fund returns, you first need to know about NAV. NAV stands for net asset value. NAV is the price of 1 unit of a mutual fund. Every mutual fund has a NAV. The NAV changes every business day based on the value of the investments held by the mutual fund. Real life example. Suppose today's NAV is 20 rupees. You invest 2000 rupees. Number of units you will receive is 2000 divided by 20, which is 100 units. You now own 100 mutual fund units. Now we will see how mutual fund returns are calculated. Mutual fund returns mainly depend on changes in NAV. When the investments inside the mutual fund increase in value, the NAV rises. When the investments decrease in value, the NAV falls. Your return depends on the difference between the purchase NAV and the current NAV. Here you can see the simple formula. Return equal to current investment value minus original investment amount. Now we will see the example of profit. Suppose you invest 10,000 rupees. The NAV is 20 rupees. So you receive 500 units because 10,000 divided by 20 is 500. After 1 year, the NAV becomes 24 rupees. So your investment value becomes 500 into 24 rupees, which is 12,000 rupees. You invested 10,000 rupees, your current value is 12,000 rupees. So your profit is 2,000 rupees. Now we will see the example of loss. Suppose you invest 10,000 rupees, the NAV is 20 rupees, you receive 500 units, later the NAV falls to 18 rupees. So your investment value becomes 500 into 18 rupees, which is 9,000 rupees. You invested 10,000 rupees, but the current value is 9,000 rupees. So your loss is 1,000 rupees. What makes NAV go up or down? Many factors can change the NAV. Some common reasons are stock prices increase or decrease, bond prices change, market conditions improve or worsen, company performance changes, economic events affect the investments. When the investments perform well, the NAV usually increases. When the investments perform poorly, the NAV usually decreases. What is the return percentage? Many people like to know returns as a percentage. Here you can see the formula. Return percentage equal to profit divided by original investment into 100. Here you can see the example. Investment is 10,000 rupees, current value is 12,000 rupees, so profit is 2,000 rupees. Return percentage is 2000 divided by 10,000 into 100, which is 20%. So your mutual fund has given a 20% return. Now the question is, does a higher NAV mean a better mutual fund? Many beginners think a mutual fund with a higher NAV is better. That is not correct. The higher NAV simply means one unit has a higher price. A mutual fund with an NAV of 50 rupees is not automatically better than a mutual fund with an NAV of 20 rupees. What really matters is long-term performance, consistency, risk level, and investment objective. What happens if you invest more later? Many investors add money regularly through a systematic investment plan, which is SIP. Each monthly investment buys units at the current NAV. Sometimes you receive more units, sometimes you receive fewer units. Over the time, this helps average your purchase cost. Now we will see real life example. Suppose you invest 1000 rupees every month. Month 1 NAV is 20 rupees. So you will get 50 units. Month 2 NAV is 25 rupees. So you will get 40 units. Month 3 NAV is 16 rupees. So you will get 62.5 units. Number of units changes because of the NAV changes. Why you should check returns over the long term? Mutual funds usually perform better when you stay invested for several years. Daily changes in NAV are normal. Looking only at one day's return may not give the full picture. Many investors review returns over 3 years, 5 years, or even 10 years. Here you can see the summary of whatever we have discussed.